Meeting is being live streamed. Okay.
Okay, we are live on YouTube, but I've disabled it for now. I've paused it for now. Okay, good luck, San and Ashok Bhai. You guys don't need it, of course. We need one. We will open the gates probably in another minute or so.
Can I just quickly check? Can people see me clearly? Do I need to switch on any lights or?
Perfect.
Oh, perfect. Yeah.
Great. Okay. Thank you.
So as per my clock, we still have 2 minutes to wait. So.
And Sam here is clear, yeah, for my picture and lighting.
Jai
Yeah?
Jinendra, Kiran Bhai.
Jai Jinendra, Jai Jinendra.
Jai Jinendra, Kiran bhai.
Hi, Jai Jinendra. You were speaking, so I just did this. Oh, Ashok Bhai is here. Hello. Good to see you as ever.
You're on mute, Ashok Bhai.
Good morning and nice to see you again.
Yeah,
Bye.
yeah. Sorry, carry on. I didn't want to interrupt.
Now, just waiting for it to be, I think it's just another minute. I'm going to do 11:01 if that's okay, just to keep sufficient time. But yeah, we should be able to kick off as soon as.
Yeah, I think, Nitin, sometimes people get impatient even if it's a minute late. Maybe we just start accepting them. I'll leave it that to you.
Mute all and then we accept it.
Have you muted all?
1 second.
Hi, Sam. It's Kiran here.
Hey, Jayendra. Okay.
Are they all mute, Girish bhai, or now should
We'll mute it once they join, I think now.
Okay, so I'm gonna.
Get them.
All right, 3, 2, 1. Should we go live? Okay, and then you're gonna do highlight for.
You will be doing the highlight, right?
Okay, yeah. So is it all good now?
Yeah.
Great.
Or the spotlight, you meant, okay. Yeah.
Jai Jinendra, good morning and namaste. Welcome to Jito UK's Economy and Investment Series with today's session on markets, trends and turbulence. Today, we have macroeconomic expert Ashok Shah from London and Capital and professional economist Sam Jethani from the Bank of England. But before I introduce our guest, some housekeeping is required to be done. So let me just share this slide first. So, as you would know, this session is being recorded and broadcasted live on YouTube. And you are consenting to recording. If you have any questions, comment, please reach out to us at info@jitouk.org. For audience who can't connect via Zoom, you can watch this live or recorded version on YouTube at this link. Now, I'd like to before we start the session, I'd like to have some rituals to be done. And I'd like to invite our Vice Chairman, Girish Jain, for Navkar Mantra and welcome note. So, Girish bhai, over to you.
Thank you, Nitin bhai. We'll start as usual with Navkar Mantra. Om Namo Ryantanam, Namo Siddhanam, Namo Airyanam, Namo Vajayanam, Namo Loy, Sava Savanam, Eso Pancha, Namo Karo, Sava Pava Panasano, Mangalanam, Cha Save Singh Patamang, Havi Mangalam. Om Namo Ryantanam. Thank you, everyone, for all those who have gathered here today for this exciting session focused on equity markets, long-term trends, and short-term turbulences. Before we start the session, a quick update. Jito, as an organization, as an international organization, Jito has now completed 16 years of its existence. It has now become the largest gene organization for business and professional development, and also in terms of upliftment of the community. It is not just in India, as we are aware, and now it is present in 18 countries, and many more initiatives are being undertaken with other countries as well, and the most recent one being the Canada as the latest chapter. We are also engaging now more than ever before with a lot of our international partner chapters, and you will see that in the near future we will have some more events where we are able to interact, whether we are able to touch base and have some connections with our international chapters and members within those organizations. Here in UK, we have an exciting news. As of February, as of last month, ICICI Bank, which is the national bank, which is a national level bank in India, has now become our sponsor for the year. So they are the sponsor, a silver sponsor for the year 2022. This is also a testimonial to the growing awareness of Jito UK as a brand, and also a recognition. So I think we all as members and everyone associated with Jito UK must really be proud of. But this will also bring a lot of advantages, and there will be a lot more events. We will be communicating those in due course, sending out some formal communications. So please do watch out this space. Now that we are through pandemic, a lot of events are happening. People are busy with a lot of face-to-face events, and we don't want to be left behind. We have a social event coming up on 21st of May. We will be sending out some communications, but 21st May evening will be one of our social event face-to-face, and perhaps this is a good opportunity for all of us to meet after 2-3 years of not having seen each other. The event will be held in London, and more details will be sent out later on through the usual channels. One thing we want to make sure is that we do want to engage, whether it is members or non-members here in UK. We want to encourage that you come up with ideas. If you have any ideas that you want to take up with Jito UK, please contact us. Contact any of the committee members. You can find contact details on our website, or fill up the contact form on the website, and we will get in touch. But what we do want to encourage is to hear from you. What kind of other events do you need? What are the other topics that you want to be addressed? If there is amongst you, there is a potential speaker, or there is someone you know who you want to introduce us, please do reach out. We would welcome that, and we are very keen that we have some people within from our community, people we know, people from our members or non-members, to come up and engage with us to make sure that we are planning some events which directly cater to your interest. I think we have a list of events that we will be doing this year. And I think Nitin Bhai and others will probably go through that in due course. But please save the date, 21st May, for the social event happening here in London. We'll get back to our session now, and thanks everyone for joining.
Thank you, Girish Bhai. Thank you. So before we move on, I have to do more disclaimers, and I'd like to share our official disclaimer as well. So basically, just to highlight, this is the material does not constitute or undertake to give any advice or any nature, including fiduciary investment advice, nor it is intended to serve as the primary basis for an investment decision. Prospective investors are recommended to seek independent legal, financial, and tax advice before making any decision. Informations and opinions are presented have been obtained or derived from sources believed to be reliable and current. However, Jito UK cannot guarantee the source's accuracy or completeness. The views and opinions expressed as a part of this material should not be constituted as solicited advice by Jito UK, presenters, associated entities, or any participants, and we will not be liable for any loss. Individuals are strongly recommended to seek professional advice as appropriate before making any financial decision. And hence, it's just that, we want to ensure that people understand this is, for information session only. Now, I'd like to invite our first guest speaker, Ashok Shah. Ashok Shah has over 40 years of experience within investment and financial markets. He is an investment director at London and Capital since 2012. And before that, he held position of a chief investment officer and head of global investment strategy between 2002 and 2012. Prior to joining London Capital, he was head of emerging market equities at Old Mutual Asset Manager. Ashok Shah is a frequent speaker and commentator at CNBC's Squawk Box Europe. So without further ado, I'd like to pass the baton to Ashok Shah, and he would be able to start his presentation. So please welcome Ashok Bhai.
Good morning, everybody. Nice that you can join us. What I want to do in today's session really is to cover some of the basic things we need to understand about the global economy to help us make investment decisions. So I want to cover really business and investment cycle. I want to cover inflation cycle, and follow that with the interest rate cycle, inflation rate cycle, monetary cycle, and the debt cycle. And when we sum it all together, we'll get a pretty good idea about how much risk you should really be embedding in your portfolio in aggregate. And then you can later on decide how that risk is then segmented into various asset classes and so on. Now, to begin with, what I want to do is to share a presentation which I think will help the So let me start. Okay. So yet again, a big disclaimer, like everything else, we have to make sure that you get proper professional advice before you engage in any investment activity. I leave it for you guys to read this later on, as it will be put on the website. So I want to just start with one very basic slide about how an economic cycle typically evolves. And if you think about, effectively when you go into the recession, and then the system responds to try and shorten the time spent in recession and the depth of the recession, and then you come out into a recovery phase, which goes on for a while, and then you go into the mature part of the cycle, and then something happens. Usually inflation gets out of control, central bankers respond by raising interest rates, or you can get an exogenous event like in last cycle we had COVID, which nobody could predict, which ended the cycle. Now, last economic cycle was, of course, most unusual because it was the longest one in the US economic history, more than 12 years. This cycle is also turning out to be an incredibly different cycle from last half a dozen cycles, simply because it's evolving at a super fast speed. And the reason that this cycle is a very, very accelerated cycle is simply the fact that the system, in terms of the central bankers and the monetary authorities, the governments, responded extremely aggressively in the middle of the COVID crisis to ensure that the decision to voluntarily close more than 50% of the economy did not become 1929 replay. And that meant that massive fiscal and monetary stimulus was applied. So the amount of time spent in the recession was incredibly short. Normally, we would spend 2 or 3 quarters in a recession. This time around, we spent less than a quarter of before we came out. And because the amount of stimulus was applied was so enormous, the first part of the economic cycle typically takes 2 years in a normal cycle of 7.5, 8 years. This time around, the first part of the economic cycle was almost done within 1 to 1.5 quarters. And to understand how fast the recovery was, to simply think about what happened to China in first quarter of last year when it was growing in excess of 18% annualized rate. This is the world's second largest economy, remember. So the first part of the cycle was pretty much done and dusted within 1.5 quarters. Typically, the first part of the cycle might last 2 years. And then we got into the middle part of the cycle, which typically would have lasted 3-4 years. And this time around, I suspect that we are already through the middle part of the cycle in about a year, 1.25 years. And it was a very accelerated middle cycle yet again. And the consequences of this accelerated cycle, of course, was that inflation turned very, very fast. And we are now probably, if you look at a football terminology, well past into 75 minutes of the 90-minute game. So we are approaching, you know, the more mature part of the cycle already. So now things, of course, have changed dramatically in this cycle because, you know, we're now in the thick of the war already, into the second month in the Ukraine-Russian war. And what that has done is to effectively create a huge crisis, both in terms of energy prices going exponential and the food prices going exponential as well. And we'll come to a bit more of that later. But this is a simulation, you know, which indicates the damage that is likely to be inflicted on the world growth rate. You know, you can see it's about 0.5% for this year and about 1% for next year. So that's a pretty big reduction in the world growth rate. And the world growth rate was already calming down before that. And if you look at the US expectations for this year, this is 2022 on the left and 2022 on the right, you can see that 2022 expectations are now coming down quite hard in terms of consensus. And we are already under 3%. So remember that on a long-term basis, the US potential growth rate is around 2%, 1.75% to 2%. So we're still in that sense, even though slowing, growing above potential for this year. However, next year, you know, we are going to probably grow a lot slower. And these estimates are likely to be revised down because it will depend on the magnitude of the economic tightening, the monetary tightening that is going to come in. And we'll cover that in just a minute. But this is basically to say that the world growth rate was already coming down. You know, US was coming down. Remember, US is the world's largest economy, and it was basically going to drag the whole world down with it. And the war just makes the slowdown even more faster. So in terms of, you know, this slowdown, how bad is it going to get that we are in front of, that we're seeing in front of us? And this is a chart from JP Morgan showing you the probability of a recession 1 year out and 3 years out. And it really, because the growth momentum at the beginning of this year was very strong, you know, this year there is no chance we're going to really see a recession because, you know, even though we are slowing, it's going to be pretty good and positive. And the consumer spending still is pretty much intact and the employment cycle is very good. However, 3 years out, the risks are increasing quite quickly. And this is something one needs to be really aware of, which is that, you know, we are going to see that this cycle, you know, could end quite abruptly. So what else is happening out there? And this is really to show you how fast the interest rate rises are going to be delivered in the US in this year. This is 2022. And, you know, we had a rate rise last week, and I'm sure all of you are very aware of it. And we probably got another 6 to 7 rate rises to come for the rest of this year, which is pretty fast, accelerated pace of tightening. And there is a lot of talk about the next rate rise is not going to be 25 basis points, but might be 50 basis points, and maybe even be followed by another 50 basis points. And I'll talk about that a little bit more when I come and, you know, drill down into how bad inflation outlook is. So a lot of tightening in terms of monetary policy in store for us in the next 12 months. Now, really, what is driving this tightening is, if you look at, first of all, how the employment cycle in the US is evolving, we are already below the optimal level of employment, after which, you know, it gets very tight. We've already seen that the job openings, you know, are in way excess of people looking for jobs. So the pendulum is now swinging in the favor of labor having pricing power after many decades when it did not have. And what that translates into is that the wages are now rising. And, you know, if you look at pretty much around 5 to 6% annualized rate, and that is really a big red flag, because it's when wages begin to rise at this level, they become self-feeding, and you can't slow it very easily unless you get the economy to slow quite dramatically. Of course, the fact that the wages are rising at this level does not necessarily mean that the employees or the employed people are well off, because the real wages is what one needs to look at. And so that's really the nominal wage growth, which is what's here. And then you got to look at inflation and adjust it. And then you see that the picture is not as bright as it looks right now. So if you look at what is happening to the inflation in the US, and pretty much the world is going through a very similar pattern as well. we can see, really speaking, that the core inflation and the headline inflations are really shooting up. And what the right-hand slide is trying to show you is that really is a uniform rise across a whole range of category of items out there. And the rises are also quite varied, but really a lot of the rises are quite meaty rises, quite meaningful rises, 4% and so forth. So this is telling us that inflation is now becoming a pretty serious issue. It is not something that, like in the last couple of decades, we were in a deflationary mode, and that mode is now changing. And so there are some fundamental changes that are taking place, and all of us need to be aware of it. And what the war in Ukraine and Russia is doing is going to make inflation really, really, really bad. And this is a simulation showing that for this year, expect the inflation to be just around 3% higher than would have been without the war, and 2% higher for next year. These are really very, very significant numbers. And these are, of course, simulation, and the reality will be slightly different from this. But the point is that, if you get inflation of, say 2% for 2 years in a row, added to what you were expecting earlier, that's a 4% extra boost to inflation. That's huge. And think about what the central bankers would have to do. That means interest rates could rise quite more significantly than earlier expectation in order to make sure inflation doesn't get out of hand and become self-fulfilling. And therein lies the huge tail risk for the financial system, which is that the tightening that we are expecting, maybe underestimating what might need to be delivered in fullness of time. And the other kind of tightening that we need to be aware of is that when we got into the crisis, the central bankers, the governments went into massive budget deficit spending. And the impact of that was that the government debt to GDP started to rise quite significantly. And in order to facilitate the market to absorb those things, it meant that the central bankers started printing a huge amounts of money. In other words, quantitative easing. And on the left-hand side is showing you that it really was a global theme. I haven't put in Bank of China, but there are similar patterns there as well. So the central bank balance sheet expanded dramatically, partly to absorb the huge supply of government bonds to fund the budget deficits. And that is now going to be changed. And we know that we are waiting for the final announcement from the Fed to indicate if it's May, when they start taking liquidity out of the system. And you can see that, projected, this is Goldman Sachs estimates, showing significant liquidity withdrawals to come in the next 24 months, 12, 24 months. And remember, we have been in a season when the tide of liquidity was coming in, and that tide lifted good, bad, and ugly up. Valuations of everything went up. Loss-making companies, went berserk and so forth initially. Of course, since the beginning of the year, they've had a big tumble. But effectively, the valuation of risk markets are driven by availability of liquidity on one side and cost of capital on the other side. And because there was too much liquidity, the liquidity had to flow somewhere, and it flowed into risk markets and took everything up. That tide is now going to be turning, and therefore the valuation compressions that we have seen, we may indeed see a bit more of that over the next 12, 24 months. Just to indicate that tide of liquidity in terms of what it did was that the pool of money out there looking for income streams, positive yielding bonds was so huge. We went into effectively a shortage of income producing assets. And here you can see that the magnitude of negative yielding bonds, remember, these are the bonds that you buy and held to maturity, guaranteed to lose you money on a nominal basis. We got to $18 trillion, and in the last few months, as the inflation tide has done and expectation on interest rate is changing, we can already see that the yield curves are adjusting quite quickly. And that means that the quantum of negative yielding assets is coming down quite quickly. This is just another way of saying that the yield structure is moving up. Bonds basically have produced negative returns, and that's how the forward rates of return improve. If the price falls now, then the forward price looks better. And if just to come into the one of the last slides is just to show you that the debt burdens in the system, advanced and emerging economies, they continue to rise, and we have not yet seen even the flattening or reversal of this. And this occurs as long as the government budget deficits, are negative. In other words, the government spending more than they're collecting, then it has to be funded with increase in debt in the system. This is just the public debt, and if you put the private and corporate debt, of course, it's even worse. It's around 350% of GDP. Now, what this has is the implication of this really is that interest rates can rise, but they cannot rise significantly higher, simply because that will then create a massive default cycle, because cost of carrying the debt rises, coupons rise, and then how do you fund them? You have to increase taxes quite dramatically to collect revenues. You increase taxes, you slow the economic growth, and you create a recession. And yet again, recession requires the government to bail you out. So we are in this catch-22 where interest rates do rise, but because the indebtedness is so high, they cannot rise dramatically. I'm just going to put this picture. I'm not going to go through all of it. There's just a couple of things on the worrying side that I want to highlight, which one needs to be aware of. One really is that what has happened in the last 12, 24 months is a reversal of globalization. Globalization that had been going on for 20 years was basically effectively a massive disinflationary thing, because we could access cheaper and cheaper goods made in faraway countries with lower unit costs. That now is reversing as we try to effectively bring production back home to have more security in terms of our supply chains and so on. And that will necessarily increase our unit costs. The other thing really at the top of our mind is, of course, the war and the uncertainty and how long it's going to last and so forth, and what the ultimate cost and implication, political and social, is going to be. We just don't know. So it's just uncertainties. The level of uncertainties are very high. And when levels of uncertainty is high, the risk premium attached to markets needs to compensate you for that. And the last one I want to mention, really, without going through all of them, is really the cyber attacks. And we should all get used to the fact that as we use more and more computer gadgets and data and electronic communication, we are all a lot more vulnerable to cyber attacks. And it's just a new form of warfare. And all of us have to be aware that this will probably get a lot worse before it gets better. And of course, it can bring systems down. That means that we have to spend huge amounts of money protecting ourselves and our utilities and so on. So if I sum it all up into a flag system, oh, I got a wrong slide here. It's green, 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 but there's a lot of it is going amber. And I think one needs to be really careful in terms of, it's not really red, but I think as months go by, we will be getting nearer and nearer red. So in other words, in terms of the overall economic and market environment, expect things to really begin to get a little worse, not better. And so this is telling you that the amount of conservatism that you built into your portfolio construction needs to keep increasing, and expect the market volatility to remain elevated for some time until the interest rate rises are fully discounted by the market, and we are halfway through the tightening of the monetary system before these things are going to change. So very quickly, I'm going to sum it up and just leave it on the screen without going too much, except to say that right now, the level of uncertainties are very, very high. And it's principally, politics is quite important, but ultimately it's really the central bankers that are driving this in terms of how fast interest rates are going to be raised and how fast the liquidity is going to be withdrawn. So we are in a season of double tightening, and we have, as a system, not experienced a double tightening before. So it's a new experiment that is being carried out, and the chances of having a mistake, chances of something going wrong are probably quite high. And in that sense, from a capital preservation point of focus, we must assume central bankers are not gods, that a probability of committing a mistake, of having a mistake from central bankers, I would assign that as a very high probability. What that actually is saying indirectly is that please do not assume we are not going to get a recession. It is quite likely we will get a recession probably in the near future. And their job is to, I suspect, will be to minimize the depth of the recession and the length of time we spend in the recession. So I'm going to hand it back over, and I'm sure that you have lots of questions, and I'm sure we'll take them at the end. Thank you all very much for listening.
Thank you, Ashok Bhai. Thank you. It was, as always, very stimulating insights from your macroeconomic trends and the expertise and the voice around on the policies and how the world is going to the economic landscape. So I'm sure we have more questions coming in. As you can see, some are already popular. Before we go to the Q&A round, I'd like to move to the next part of our session, is to invite our next speaker, Sam Jutani. And so let me share a brief bio first. So Sam is a professional economist with extensive experience in economic policy making. He had started his career at HM Treasury and has spent last 6 years working at the Bank of England, where his role involved working on payment policies and contingency planning for Brexit. And more recently, he has been providing advice to Monetary Policy Committee, MPC, and Financial Policy Committee, FPC, for financial markets development. So thank you so much, Sam, for joining today's session. And now I'd like to invite you to and hand over the baton to present you and share your expertise around the economic policy. And especially just to highlight, it will cover around the the budget, latest budget announcement from the government and the UK Insight. So over to you, Sam.
Fantastic. Thank you so much, Nitin Bhai. And thank you to all of you at Jito UK for inviting me to present here today. Jai Jinendra. I'm really glad to be here. I mean, my brother Ravi Jutani is part of Jito UK, so there's a good trend, and it's also nice to see some familiar faces among the audience. So lovely to be here. So as Nitin Bhai set out, my background is in public policy. I have spent the last 6 years at the Bank of England, before that at the Treasury, a few other places, and I will talk about the public policy landscape dealing with the kind of challenges that Ashok Bhai set out so clearly for us. And what I will do is quickly go through my background here. I will say, with apologies, I have a hard stop at 12 o'clock. I will have to leave you all, but my contact details are here. My email address is at the bottom, sam.jutani@gmail.com. Please do contact me with any questions that I might not be able to answer during the session. Very happy to talk about this. Just wanted to highlight a few things about my background. Firstly, that, my job over the last 2 years has been working on market intelligence gathering, developing financial market expertise. Really, what that looks like on a day-to-day basis is that I would call up people like Ashok Bhai and say, what are you seeing? How are you interpreting the world? What are you worried about? How are you analyzing things? And when that would happen, I then add that together across a range of different contacts with my own analysis and the analysis of other people in my team, and then pass that on to the Monetary Policy Committee, the Financial Policy Committee. So that's how we were doing that analysis, that mixture of quantitative, using the data of what we see on a day-to-day basis, and the qualitative, talking to traders actually in the market. And that's where I have a perspective on financial market developments. I will say that I have not been at work for the last month. I've been on parental leave. And as it says on this slide, in July, I will be leaving the Bank of England to join Flint Global, which is a strategy consultancy. I just wanted to highlight some of my other wider commitments on the side here, mainly because they add a level of perspective on the nature of the public policy challenges that we face. And I will touch on some of these. But really, let's talk about the three of the institutions that I've worked at, and the kind of key policy decisions that they're facing. This is really about taking the overall set of the overall situation that Ashok Bhai very clearly outlined, and just drilling down specifically into a UK perspective. So when it comes to the Q&A, I'm very happy to talk about UK, but Ashok Pai might be better placed for the more international perspective. I will also say, I mean, we've said this a few times, disclaimer, these opinions are mine. Any opinions I share, they are not strictly the Bank of England's or any of these other organizations who spend a lot of time and effort really crafting their own communications, and they will be able to tell you a bit more about them. But I'm hopefully going to add a bit of explanation and color so you understand what's going on. So as Ashok Pai said, central bank decisions are going to be absolutely crucial for the upcoming period of the when we decide how will financial markets work, what will happen next. And the key thing I wanted to highlight here was the dramatic change in market pricing for interest rates. So this is financial markets assessment of where Bank of England interest rates should go. And this is again from a UK perspective. So in September last year, and you'll remember in September, we saw the first signs that people were getting a bit worried about inflation. We saw speeches from the Bank of England saying, this is something we will be, from the governor of the bank saying, this is something we're keeping an eye on, we're a bit worried about it. But at that stage, on the 24th of, all of these dates were taken on all of these snapshots of 24th of each month. But on the 24th of September, the expected next rate move was going to be in 6 months' time, was scheduled for 6 months, 6 meetings time, not every month. There's not a meeting every single month. So 6 meetings time scheduled for June 2022. And the interest rates would, by the end of 2022, be 0.5%. By January, they'd already raised interest rates once, expecting the next rate rise to be in May, so in 3 meetings time, and a significant increase in rates by the end of the year. And just last week, if we took, these are the 24th of March, so on Thursday, I took a look at the data, and markets were expecting, again, a big shift up in interest rates, both at the next meeting and then at further meetings, so that by the end of this year, interest rates are significantly higher than we were expecting 6 months ago. So in 6 months' time, that's a dramatic change in financial market expectations. And I wanted to highlight that we are in a really uncertain world. I think more so than any other time in my professional career, in my professional life, the level of uncertainty on central bank decisions, as Ashok Pai clearly said, the twin tightening, this is an experiment. We've never done this before. And I've had conversations with MPC members, with governors and deputy governors at the Bank of England, where they talk about, actually, this is really challenging. One of the things that happens is there's a lot of commentary. There's a lot of news, a lot of information in the press. People will, whatever they do, criticize, but they are responsible for making what they hope is the right decision. And that is the thing that literally does keep them up at night. So it is worth thinking about them and hoping that they make the right decision. Ashok Pai also talked about sort of the role of the fiscal authority, so the Treasury, and we had a mini budget on Wednesday last week, and it's worth thinking through the short-term versus the medium-term implications. So, of course, the headlines are all short-term focused on the cost of living crisis. So the change to the national insurance threshold, a forthcoming increase in tax rates there, prospect of income tax cuts, adjustments to fuel duty. That is, I would encourage, and that's really important for the short-term, helping people get through the day, get through the week, get through the year. It does really matter. And these are amounts that really do make a big difference to many people's lives. But when it comes to investment decisions, think about the medium term, especially on debt sustainability. So as Ashok Pai talked about, the levels of debt are significant, with inflation rising and bond repricing happening in such a way that repayments will be much higher than we have seen before. You do have a big challenge. But the OBR's judgment, the Office for Budget Responsibility, they're tasked with analyzing the economic and fiscal outlook for the UK. They've said, despite these economic headwinds, public finances have continued to recover from the pandemic more quickly than we expected. That's quite a big and strong statement. That's something that's really important to someone like Rishi Sunak, who is very worried about making sure he's got money in the tank so that we can deal with a future problem. I'd also encourage people, when we think about these things, to think about the short or the medium term, but not to think too much more than 3 to 5 years ahead. The long term is difficult. And, John Maynard Keynes is, his famous phrase was, in the long run, we're all dead. What he really meant by that was not that he didn't care, but that it doesn't really make any difference to say, oh, by 2050, we won't worry about COVID. That's a sort of slightly useless statement, isn't it? We need to worry about it now. We need to make sure that we can get through this right now. We need to worry about the level of public debt. We need to worry about making sure that people can deal with inflation in the short run. It's no good to say by 2035, markets are expecting that inflation is at target and it'll be fine. That means nothing. So in that sense, it is really important to just stay abreast of all the issues and debates and making sure that you don't plan for a future and lock yourself into a future that is too far ahead. The other key point I wanted to make is thinking through that debt sustainability issue. Now, there's an issue about sort of financial, about the public sector debt. And then there is this wider stuff. And I've seen we've had a couple of questions already thinking through, what does inflation look like? And are these numbers real? Look at how serious this is. These are really significant short-term challenges to the British economy. So what this says to me is that the UK economy is going to face really serious headwinds that will make it very, very difficult for it to bounce back in the way that we had perhaps predicted when the pandemic came to an end. So we were hoping that GDP growth, to give context, GDP growth is typically in a normal year 2 to 3%. When you have a recession, you expect a little bit of a bounce back, something a bit more than normal to recover all of the growth and economic activity that had been cut back. We were expecting 6% growth, which would have been pretty stellar for the UK economy, but absolutely understandable at a time when we're reopening. The fact that it's been cut so hard is it means something quite serious in terms of economic activity, people's jobs and livelihoods. And that is, I think, directly related to the fall in living standards and the increase in costs that they're facing from inflation. And the final point I wanted to just draw out was about my role, thinking about my role at the Money Advice Service and personal finances. So there are a couple of things that are worth just noting from as a result of the budget, the spring statement that we had earlier in this year. The first is that break-even point at which you would pay more because of the increase in national insurance rather than less because of the increase in the threshold is around £35,000. So put it another way, if you earn more than £35,000, you will pay more tax. If you earn less than £35,000, you will pay less tax. What you will also see is a huge wedge, an increase in the wedge between taxes on earnings and the taxes on pensions and unearned incomes. So what you will see is where you have an investment and you are receiving capital gains, you will get even more benefit than if that money had been coming into you from a job where you'd got a higher salary. I'd highlight this point. I've just said on the previous slide, inflation will be more than 8%, but benefits are going up by just 3.1%. So that is the poorest people, the people who are most vulnerable, the people who are least able to work, will be getting a significant cut in their benefits and their ability to live at the same time as they're dealing with these higher costs. So I think that's an important point, just thinking about this community and this group and thinking about our commitment as Janes to people around us. I'd encourage everyone to think about that as a part of their financial decision making. Where can we do some good? And the final point is, as we've seen, the market pricing for interest rates is for them to rise. So if you can, fix your mortgage rate as soon as you can, because mortgages will only the rates on mortgages will only get higher. And that's advice that's come directly from the likes of Martin Lewis. So my final thought, this is really just a broad point that, echoes what Ashok Bhai said and what a few other people have said. Your risky assets, things like your equities, your crypto, these have had a real boom over the last few years as you've had an enormous amount of liquidity of central bank support. That's been true in the UK just as much as it's been true elsewhere in Europe and the US. You should expect that they are on the downside of that seesaw for a reason. And I just say that very advisedly, just that it looks like they are going to face a really challenging prospect. In contrast, safe assets, government bonds, corporate bonds, these are ones that will offer much less by way of return, but will be safer. So when things become very difficult for the economy, those are the ones that are safe. The demand for government bonds and corporate bonds may then push up the price. And so the challenge here is getting your timing right on when you switch from one to the other. But the important thing, and I think this is really important about, we've said this a number of times as part of your investment decision, they should be personal, they should be based on your own risk profile, and do not get caught up in hype. I have heard from many people who have said they got caught up in exciting news that they see on TV, bought something at the wrong time just before it's crashed. Do make sure that you are just watching everything very carefully for your own benefit, not for the benefit of someone who's on TV and trying to sell you something. I'll stop there and very happy to move to Q&A.
Thank you, Sam. It was really lovely to hear, and it's great to share your insights from the being one of the policymaker as well, and trying to really, it has a direct impact on day-to-day life. So now, before I would like to move quickly to Q&A, I just want to have a quick round of follow up on certain about the membership as well as the future events we are planning at Jito UK. So if anybody would like to be part of Jito UK as a membership, please connect to us. You can drop me an email, or you can drop an email at membership@jitouk.org. And as you see, this is one of those platform which connects irrespective of your priorities or beliefs. It's more about connecting all us as Jain, and we are connected globally as well, and we connect to across the world, right from east to west. So feel free to reach out to if you want to be proactive member as well as contributor to this committee. And very quick update on the future event. As we have this, I would like to announce the date for next Social Connect, which is physical event, and we would like to really have friends and family together. And this is planned for 21st of May, and the location will be London, but further details will be announced shortly. We're also planning to do several other events in the due course throughout 2022. That includes Finance for Ladies, that's webinar, and then startup pitch coming in. Then we'll have another social, I've already just highlighted in May, and then we will have digital business and marketing. We intend to do another big event on pensions, will, inheritance tax, and planning. That will be a physical event, and then we would like to follow further. So please reach out to us if you have any questions, comments with regard to, we can follow from there. Okay, now I'd like to move to the Q&A round, which is where most of our audience are waiting for. So once again, Ashok Bhai and Sam, thank you for joining. And could you please undo yourself, unmute, please, so we just make sure that we can hear you.
Yeah.
Okay, so as you've seen several questions through the chat, but I think I'll have to be really selective. And I know you have hard stop, Sam, so would like to really start with that round as well. There's another again, I think people want to hear more specific around the rising interest rate and the worsening economic conditions. And how does it impact the commodities and stock in general? But one of the concern as well is which is linked to it, what has gone wrong from the Bank of England perspective is why we did not have foresight of the steep rise in interest rate versus, was more predictable. What is this? Is this the external turbulence, or is something really missed in the policy making level?
Yeah, I'm happy to talk about that. Let me take that last question first. So as a policymaker, it's really important to demonstrate humility. The only way we will know whether we've missed something is through a serious, rigorous analysis that we'll be able to do afterwards. We will, these are things that happen all the time. So we have done these sorts of analyses for, the financial crisis. Did we make mistakes? Where were they? Could we have done things better? Ashok Pai said it well, that, there's a huge amount that central banks are trying to manage, and this is a bit of a risk, a bit of an experiment, and people are trying to do this with all of the best judgment that they can, with the best information that they can. That doesn't mean that we haven't made mistakes, but that trying to understand what that looks like is challenging. The key point that I will make, though, specifically about what we're doing now, what the Bank of England's trying to do now, and the Monetary Policy Committee, is that they're trying to balance a very fragile recovery and a very fragile reopening from the COVID pandemic alongside risks around inflation. There is a degree to which we are in absolutely uncharted territory. We didn't, the Bank of England is filled with economic policymakers. We get good advice, and I have sat in some of those meetings with the likes of Chris Whitty, but we're not epidemiologists. We don't know the impact of a vaccine. We don't know what take-up of a vaccine is going to look like, and when that's what kind of impact that will have on people's behavior, on people's willingness to get back on a train, go back into the office, go and spend money in shops. So there's a lot of uncertainty. Alongside that, there is a real responsibility not to crash the economy by raising rates or tightening the economic cycle too fast. There is a risk that policy mistakes could be made in that way, and that that's the challenge. The final point I would make on this question is interest rates take some time to take effect, about 18 months to 2 years to fully pass through. And what you have is a situation where for interest rates to have adequately made a difference to the impact of gas prices or other energy prices now, you would have had to start raising rates in the summer of 2020. At that point, the summer of 2020, we were right in the middle of the pandemic, and we were, if you looked at energy gas futures at that point, they were around 44p a therm. They are now in the region of around 10 times that amount. So we are, we're facing really fast repricing. We're facing policy tools that just don't work quite as quickly as the market repricing does. There was another question, which was, you asked a question about the worsening economic impact condition for banks and commodity stocks. So, perhaps Ashok Pai can talk a little bit more detail about this. What I will say is bank stocks tend to be much more, bank stocks tend to be less reactive to the economic cycle, I think, than other stocks, and much more focused on core business and how that develops over time, and what these wider structural changes mean for their business opportunities. So I would say that that's a question of, are they exposed to China? Are they exposed to Russia? What kind of ability do they have to focus on, say, retail profits? I wouldn't go further than that myself, but perhaps Ashok Pai can.
Thanks, Sam. Ashok Pai, if you want to add a comment about the policymaking before I wanted to dig into more of the inflations and the numbers, our audience want to understand.
Okay. No, I think it was a very good question. So, what are the root causes for the inflation spurt that we are seeing right now? So really at the bottom of the pyramid, what ignited this inflation cycle was simply the lost demand because of the COVID was replaced by the government through fiscal deficit spending. And we were not sure, nobody knew how much lost demand needed to be replaced. Nobody had a clue, how bad the recession would have got. And so this preemptive action was taken. And we put a little bit too much money to create too much demand. And what they did was took out the spare capacity. And because the shape of the reopening and the shape of the consumer spending and the business spending were different from the previous cycle. When we were locked down, you could only buy through your Amazon or internet. You couldn't go to the shops. You couldn't go and visit another country. So the demand was on manufactured goods, not services. So it was that imbalanced spending. And that's how the whole system started getting inflationary spike. Make things worse was all the bottlenecks that you hear about around the world in terms of containers in the wrong place, ships in the wrong place. And so very quickly, a price of a 40-foot container went from $2,000 to $14,000. By the way, those prices are rising again in the last 2 weeks as the lockdown in China intensifies, which we don't have time to go into in detail. So the supply chains right now are getting worse, not improving. Initially, the expectation was that the supply chain issues will resolve by end of last year, then by middle of this year, now end of this year before they're fully resolved. So that grit in the system, the number of ships waiting outside LA ports to number of ships waiting outside Chinese ports have started to rise again. And so if you monitor all these things, it indicates that the inflationary pressures because of the supply chain issues are not getting resolved. So the inflation is getting more and more embedded. On top of that, COVID changed the lifestyle of a lot of people. People want to not live in big towns, want to more space. So you have this migration taking place, where people are living, change of lifestyle. COVID has introduced people to have a much better work-life rebalance and so forth. And so what you get is people quite happy to take less money for more social time. And so effectively, we have a shortage of labor developing much earlier than we were expecting before. And that's created yet another inflation feedback loop. So some of this, you can see from what I'm saying, the inflation is now becoming a little bit more embedded and more stubborn, and it might actually spike higher because of the war. And don't be surprised to see inflation going through 10% in UK and the US very, very soon in the next 2 months. So you can't have interest rate at zero when inflation is 10%. It just doesn't make sense. And that's why the tightening is going to take place, and the impact on the financial markets is pretty straightforward. So I'm going to leave it at that. On the banks, very quickly, remember that the 2008-9, the great financial crisis, was banks were too leveraged, they're too little shareholder capital, risk capital, and then you had the Basel II and Basel III reserve requirements. All of that was to stop the banks being bailed out by the taxpayers going forward, and that process has not finished. Basel IV goes until 2026. So their strengthening of balance sheet continues, and they have not been at the forefront of the COVID crisis. They have been very well behaved. They have not had an opportunity to misbehave. And in that sense, the credit upgrade cycle that we have seen in the banking sector for the last 10 years, since the great financial crisis, continues still for a few more years. In terms of bank equity, so strengthening balance sheet is very good for the investing in the middle of the bank balance sheet, not necessarily at the tail end of the balance sheet. Equity is at the tail end of the balance sheet. Strengthening balance sheet effectively means rate of return on equity goes down because embedded leverage goes down. So it's great if you own bank bonds because you've got the credit upgrade cycle behind you, but it's bad if you own equity because rate of return on equity is falling. Now, banks are very sensitive when yield curve changes because they borrow long and lend, borrow short, lend long, so their margins improve, profitability improves. But at the end of the day, there is this tail risk that if we get into the recession, you are going to get a non-performing loan cycle which the banks have to absorb. But in this cycle, a lot more lending is done by non-bank financial institutions as opposed to the bank. So the real damage will be on the non-bank financial institution. That is not to say that the banking sector will be immune. It will still get hit, which is why the bank shares are doing what they are doing. So I'm going to just leave it at that. I hope there was a decent explanation.
No, that's very, very well. And thank you, Ashok Bhai. I know, Sam, you need to leave in very short time frame, in 3 minutes time, and I'd like to really, you've both used the joint, very interesting terminology called double tightening or twin tightening. And I think what I want to understand from very quick note from Sam, starting with you, is to really see how will our investors or audiences should really work towards protecting their asset value, or else I would say, what are the markets which will be less, more resilient to these things? What are those assets, investments, the sectors you think about will be more resilient to this double tightening? So Sam, over to you first, and then we can follow up Ashok bhai.
So this is a really challenging question for me, simply because I've spent my career thinking about these questions from a public policy perspective, right? So this is, trying to think about what the right answer is in terms of an investment decision. Ashok bhai may be, better placed to say that. But in as much as these are, this is talking about a effectively financial market tightening. So it would be, what we're talking about is reducing the liquidity, that extra liquidity that the central bank pumped in, reducing that and taking that out of the system. It should have, we hope, a similar effect to increasing interest rates. And so you would look for those sectors that are not affected by increasing interest rates, or by or that would perhaps benefit from increased interest rates. So, Ashok bhai, you're probably better placed to think about this, but, I might think about perhaps property, perhaps sometimes international trade and shipping. There might be one or two others that I think would be better placed, but that's really how to think about this. This double tightening is, just think of it as sort of a super interest rate increase.
Thank you, Sam. That's very helpful. Thanks once again for joining. Pleasure to have you aboard.
Real pleasure to be here, and thank you so much. I look forward to hearing more from others. If you have any further questions for me directly, please do get in touch. Thank you.
For audiences, we'll continue our talk with Ashok bhai, but Sam had to leave, so we'll just continue our session as we go. So thanks, Sam, once again. So moving back to you, Ashok bhai, in terms of double tightening, and again, what our audiences are looking for is the avenues they can really protect their asset values, but at the same time, find or move their money towards the resilient avenues or markets.
Okay. Obviously, the whole world is faced with this conundrum of what the hell to do with your assets right now, given we are in a very accelerated interest rate rise cycle, and also drainage of liquidity, which could get quite bad in 6 months, a year from now, when other central bankers, in addition to Bank of England and the Federal Reserve, decide to do the same. The only, just want to mention a counterpoint, which is that China's monetary cycle is in opposite direction to the Western cycle, where they're already cutting interest rates and they're injecting liquidity, because they started tightening much, much earlier. And therefore, the slowdown as the effect of the tightening is with them here. So they're doing the reversal of that policy. But I'm going to leave that alone for a minute. So really, let's just talk about, when interest rates go up, clearly, when you talk about fixed income, let's start with the fixed income. So bonds and things like that, whether it's government bonds or other bonds. So effectively, rising interest rates are really bad for bonds generally, because bonds, as you know, the conventional bonds where coupons are fixed and the capital is fixed, the discount rate is going up, then the value of that bond present value goes down. Period. That's it. So you're going to get negative returns on the bonds. That's exactly what's been happening in the last few quarters. And there's probably a bit more of that still left in. But the more bank bonds move on the expected, in other words, the discount, the forthcoming rate rises, not the actual rate rises. They're forward looking. So they might discount 3, 4, 5 rate increases to come, as opposed to what is being delivered. So it's an anticipation. However, the way to protect your bond portfolio is simply to make sure that, first of all, your credit quality is very high. In other words, the weaker the credit quality, and if interest rate cycle results in an accident of recession, you get default, then the higher risk bonds tend to get punished a lot more. So you need to be a bit more careful about your high risk bonds. In terms of where to be is, again, longer the duration of the bond, longer the maturity profile of the bond, more sensitive it will be to the interest rate rises. So in other words, you need to moderate your duration risk, or make sure that your maturity profile is shorter, 2 to 5, 6 years in maturity profile. Effectively, you have an indirect way of compensating you for the interest rate rises on the back of inflation, which is that as the bonds mature in 1 to 3 years time, you can reinvest in higher coupon bonds that are available. So that's an indirect way of inflation hedging. Of course, the conventional way, the standardized way of investing in rising interest rate cycle and on back of higher inflation cycle is to buy inflation protected securities, so TIPS or index linked bonds or inflation linked bonds. But the point is that that category of fixed income, the total quantum available is not huge compared to the demand. So there had been a squeeze on the price on that. They were very, very expensively priced because the pension funds and so on were forced to match their asset liability. And so they basically become fairly expensive category. And they move a lot. Their volatility is in part largely driven by changes in inflation expectation. So it's a very difficult conundrum. I think a lot of the good returns from those inflation-linked bonds has already been delivered. There may be a bit more, but not that much more, I suspect. It's difficult to call on that. In terms of, obviously, the inflation beneficiaries in asset markets are, of course, commodities, which prices rise as we've seen in the last 6 months. And I think that will continue to be the case. And one of the other subsection of the commodity that benefits from inflation is, of course, gold, which maintains real value, but that's much more longer term, not on short term 1 or 2 year basis, but on a 5-10 year basis. Gold does tend to give you some protection of store as a store of value. Now I think come to the most two asset classes most people really interested in. One is the real estate and the other is the equities. Of course, in terms of the equities, you need to be very careful that if your balance sheet is leveraged, refinancing your maturing debt is going to get more and more expensive. So typically you need to migrate to lower indebted companies or cash rich companies because they have a lot less impact on the balance sheet because of the interest rate rises. But of course, ultimately you want to make sure that what they sell, they are able to protect their margins. In other words, if input costs are going up for whatever reason, commodity prices going up and so forth, that they are able to increase their output costs. In other words, they can protect their margins. So you need low indebtedness in your balance sheet and resilience in your revenue account because they can maintain the margins. So there's a lot of work to do in terms of which subsectors and where to go to get that protection or safety. In terms of the real estate, of course, initially, ultimately, real estate is all about the present value of the discounted rental stream allowing for depreciation and renovations and stuff like that. So yet again, the property can be incredibly interest rate sensitive. And the first round impact of interest rate rises is normally negative for inflation. It's much more later, especially if the interest rate rises are driven by inflation, then you would expect that the rentals, as they get reset, will actually begin to lift up. In other words, there is a prospect of rising income stream. And that will compensate you again for interest rate rises. Discount rate is going up, but so is the value of your rental stream to come down, so that the net value might effectively be neutral or positive, depending on what subsector of the real estate you are in. So obviously, there's a lot of work to do in terms of where to hide in real estate to be first immunized from interest rate rises and then to benefit from inflation, which drives higher rental income streams. And of course, we've seen in the last year, 2 years, since the lockdown specifically, that, because the way people shop is changing fundamentally, it's not going to go back, which means that the warehousing has been a very, very big, attractive sector, delivering very positive returns, as warehouses demand continues to rise, strongly and still does. And that sector has done very well. And there's a lot of new money from institutions going into that warehousing subsector. Again, for small investors, I'm not sure, unless you own warehouses that you can rent to big retail corporations or so on, internet companies, how you could get exposure to that. So I'm going to just leave it at that. I think there's a decent exposure on that subject.
Thank you, Ashok Bhai. It's very well detailed answer to the questions, I think, and it covers quite a variety of different set of questions we had from audience. I'd like to go on one more question, which is, more of the global perspective. I think, so of course, it's not pretty clear which direction this crisis is about the Ukraine-Russia is going to go ahead. But I think what sort of trend we will see from the world economic perspective? I mean, are we going to see set of economies operating Russia plus and Russia minus? Is it something, and how would it impact the trade, global trade, particularly, of course, the energy prices we can see because of immediate impacting our life? So I'd like to really understand how it's going to go.
Yeah, it's a very tough question, and you can see from all the financial press, this is a question that everybody's trying to put some comments or commentary on it. Of course, I try to capture it by simply deglobalization is the one, and that will accelerate. But I think the energy security will become a very, very high on agenda. It's quite likely that in matter of a couple of quarters, most of the Western world will not be consuming Russian energy, and of course, India and China, I think, will continue to consume Russian energy, gas, and oil, and there will be political consequences for both of them in the years to come. In terms of the Western world, I think it will try to find its own energy security. So that means that the legislation around drilling, and whether it's shale oil or whatever you want to fracturing and all that, all the regulations in terms of putting new pipelines in, and so all of them are going to be relaxed across US, Canada, UK, Europe. Limitations that were put on North Sea oil drilling, all of those limitations are going to come off because politically driven economic security on energy overrides everything else. Of course, part of the problem was the drive to green energy and zero carbon transmission. And that had already made life difficult for the dirty energy companies and all. They're going to get a respite, because I think you will find that temporarily, politically, we may even delay going to zero carbon for a couple of years while the system reorganizes to reduce dependency on imported energy from Russia. And especially for Europe, obviously safety lines are getting put in by the US and Canada, and more will be put in to insulate them from the damage from Russia. But all of this is telling you that the unit cost of doing business is going to go up. Bringing production home, which is roughly the theme, deglobalization, which is what the theme is. It increases. It's an inflationary theme. Globalization was a deflationary thing, and that means our unit cost will be higher, and effectively inflation will be slightly higher, interest rates will be slightly higher on the back of that. So there are a lot of long-term consequences and costs which the system will have to absorb. So the profitability of the corporate sector has benefited dramatically from higher margins because of globalization. Some of that is going to slow or stop. So there are going to be a lot of implications, and it's very difficult at this point to actually work it out, how you can capitalize on it. So I think we can, as you see, it is a very complicated and detailed subject with so many threads around it. So it takes quite some time to put them all together to actually say, therefore, what do we do about it? So very complex.
Thank you, Ashok Bhai. It's definitely a situation nobody in the world knows at the moment which will pan out. But I mean, perhaps we can just, slightly, trying to understand your thought as well in terms of which direction, because, let's say Russia stopped saying, okay, we are backing down. Would that mean these sanctions? Because, there is a phasing you want to live through, right? So the sanctions, one is they come over immediately, or else it takes time, because, there will be that animosity or that mindset of, keeping Russia punished for a certain period of time from the West. And how does it happen in the past, or what do you think which direction could happen? Because, as soon as war starts wrapping up, then there's another part of phase we have to live through. And any thoughts on that?
Yeah, so I mean, I would not expect the sanctions to be lifted in a hurry. It's going to be long term before anything changes in that direction. Russia is going to get isolated. Its financial system is already blocked from the world financial system. None of those things are going to be changing in a hurry. I don't think any of that is going to change. What will change is reconstruction of Ukraine So there'll be a Marshall Plan of some kind put in force to rebuild all those cities and utilities and facilities that have been decimated. Remember that the estimates from UN are that 10 million people have been displaced. 10 million, or 4 million have left Ukraine. That's what they're saying. We don't have the final numbers. This is a huge crisis at a very accelerated pace. So the cost of all of that in the neighboring countries, Poland and so on, is huge. So they are all going to be needed to be bailed out by the Western world over the coming quarters. There's no escaping that. They're doing the heavy lifting for all of us, and they'll be compensated in time. So there are all of that unit cost, but the reconstruction will create lots of opportunities. Obviously, the food security is now going to go right back on the top of the agenda. The common agriculture policy, which everybody was poo-pooing, all of a sudden will be saying, what a good idea. We didn't understand why we need it. China has very similar, where food security in China is very good because the state controls most of the distribution and warehousing of the surplus stocks and so forth. And it has no real inflation impact of the higher food prices in China right now. So I think a lot more of that is going to be happening. And that will create huge opportunities for companies that are able to carry out those policies, driven by politicians. So I think there are lots of new opportunities. We just need to be patient before we begin to capitalize on them.
Sure. Thank you, Ashok bhai. I'll only take one last question. I think this is again recurring theme right at the start and as well. I think is if somebody can really have the magic wand to predict where the interest rate will be, in let's say end of December this year or as well as end of 2023, I think really like to say, because I'm sure people didn't expect this steep rise in just 2 months time from almost at 0.75, and then again we are seeing, as Sam said, it could be 2.25, which is close to big housing market crash near 2008. So what sort of things we're looking at?
Actually, it's a fantastic question, and I'm going to give you an answer. It's probably going to surprise a lot of people. Just before I start, just to give you an idea of how big the interest rate rises have been. The cost of 30-year fixed mortgage in the US 3 months ago was around 3%. As of last week, it was 4.5%. That is a 50% increase in the coupon in your interest payments for new mortgages. 50% increase in cost of mortgages 30-year fixed in the US. That's how the interest rates have already moved in the market. And it might get worse because Federal Reserve was supporting mortgage-backed securities by putting a floor and buying it, and now it's going to stop buying it and effectively start unwinding it. Okay, so that was just to make sure people got their minds around how bad it is already. What the forward markets were saying last week was that they were already beginning to discount interest rate cuts in the second half and second half of 2023 and first half of 2024. I repeat that. The forward markets were beginning to discount interest rate cuts in the second half of 2023 and rises in 2024. So what are these forward markets, fixed income guys, who are the smartest guys in the world? What are they thinking? What they're saying is that what the Fed wants to do is effectively slow the economy dramatically and put it into recession, which means that they will then have to bail the economy out by cutting interest rates second half of next year. And then going into 2024. So it's effectively, the point I was trying to make earlier in my presentation was that the timeline to recession by the double tightening got shortened quite fast. This economic cycle was shrunk too fast, too quickly. And obviously the implication on the asset markets, is that recession, bad things happen and your risk assets get, taken to cleaners. And part of that is happening, but there may be a bit more of that to happen. So I hope that kind of generically when it says how many interest rate rises are, we actually, in reality, the central bankers have the ability to deliver. They cannot deliver all the rate rises because the recession they'll create will be so big. So in other words, even though the market forward pricing is telling you, and the Fed is telling you, that we want to do 7 rate rises for this year and a few more for next year, the ability to actually execute that is going to become questionable. And in a very short while, the market will actually tell you that the long-term terminal rate at the moment, the market has moved it from 2.5% to 3%. Will probably come back to 2.5%. In other words, the rates will go up, but that can't go up much above 2.5% at the, on the Fed. That's the short-term interest rate. So I hope that gives you a kind of a clue. But of course, as these things play themselves out, it creates huge volatility in all asset markets. Because it's the uncertainty, the tail risk is rising. And the tail risk that I want to put on the table is the tail risk that these policies create a recession rather than avoid a recession. And recession is bad for risk markets, full stop.
Thank you so much, Ashok Bhai. This has been really, I'm sure, igniting a lot of thoughts in people's mind, and the enthusiastic, economists as well as the investors who are very much keenly watching this trend. I mean, you've clearly highlighted, we will be going through another steep increase in interest rate and probably bringing up closer the recession. And, of course, there's no right or wrong tool to really address this, but at the same time, I think it's just to watch out your money and watch out your investment. I think that's the key advice you want to make to the team, to the audiences here. So thank you once again, Ashok Bhai. It was a pleasure for having you, as always. Now I'd like to wrap up the session quickly to start, to pass the baton to Suraj for welcome note. Thank you. Word of thanks note. So Suraj, over to you, please.
Thank you, Nitin Bhai. Jai Jinendra, everyone. So on behalf of Jito UK, I would like to thank Ashok Bhai and Sam Bhai for their, for sharing your expertise, your market research, and all your wisdom. It really means a lot, and it has given a lot of perspective, I hope, to everyone here. Thank you to Nitin Bhai for being the convener for the event and for his relentless efforts to make this event a success. Thank you to the Jito UK management team for bringing this event to success. And most importantly, thank you to all the attendees to attend and, communicate here on the session, and, for all your questions and making this event more enlightening. So thank you, everyone.
Okay, so thank you, Suraj Bhai, and thank you, Ashok Bhai, once again. So it's all pleasure to have you again, and enjoy your rest of the Sunday afternoon and Mother's Day celebrations. So thanks once again.